Liquidity ratio are a type of financial indicator that is used to measure a debtor's ability to repay current debt obligation without trying to increase additional funds. The first element of liquidity ratio is a current ratio. The current ratio is a liquidity ratio that evaluates a company's capacity to pay short-term or 1 year's obligation. The final calculation that we get is 2 times. We can see that Hikmat Bati Berhad's current ratio is lower than the industry average. This can improve by avoiding any capital purchase that will necessitate cash payment. The operation can increase its current ratio and liquidity. Next is the quick ratio. The quick ratio is an indicator of a company's short-term liquidity position and a measure company's ability to meet its short-term obligation with its most liquid asset. The end of calculation we get 1.18 times. We can see that the Hikmat Bati Berhad quick ratio is a good performance than the industry average. The way how to improve is a discounting, rated promotion, and rewarding sales personas can all be used to increase sales, which will then increase inventory turnover. Efficient ratio assesses a company capacity to produce revenue from its asset. The type for efficiency ratio is inventory turnover. Inventory turnover is the rate that inventory stock is sold or used and replaced. The final answer inventory turnover is 7.4x. From the calculation, we can see that Hikmat Bati Berhad's quick ratio is a good performance than the industry average. The way to improve by improving the inventory turnover require a well-thought-out marketing plan. Next is average collection period. The average collection period is an accounting metric used to represent the average number of a day between a credit sale date and the date when the purchaser remade payment. The conclusion we get is 36 days. We can see that Hikmat Bati Berhad's quick ratio is poor than the industry average. The way to improve is earlier in the life cycle, businesses are frequently more flexible with payment terms. They went back to their former client and altered the condition after they were sure it was not a problem.
Next, non-current asset turnover ratio. It measures the annual revenue generated per unit of non-current asset. After the calculation, we get 2.5 times. Hikmat Bati Berhad's non-current asset turnover ratio is good than industry average 2.0 times. The way how to improve the ratio is increasing revenue. Last one is total asset turnover ratio. These measures help investors in determining how efficiently companies use their assets to create revenue. After the calculation, we get 1.52 times. Hikmat Bati Berhad's total asset turnover ratio is poor than industry average 1.6 times. The way how to improve this ratio are increasing revenue and improving inventory management. Third ratio is leverage ratio. It used to evaluate a company's ability to meet its financial commitment. First type of this ratio is debt ratio. It shows a company's capacity to pay off its debts using its assets. After the calculation, we get 30%. Hikmat Bati Berhad's debt ratio is good than industry average 40%. The way how to improve this ratio is increasing total assets. Next is debt equity ratio. It compares the company's total obligation to its shareholder equity. After the calculation, we get 58.6%. Hikmat Bati Berhad debt equity ratio is good than industry average 60%. The way how to improve this ratio is increasing total equity. Last one is time interest rate. It measures the ability of a company to service its debt. After the calculation, we get 6.67 times. Hikmat Bati Berhad's time interest rate is poor than industry average 7 times. The way how to improve this ratio is pay down debt.
Move to the profitability ratios. The purpose of profitability ratios are analyze and evaluate a company's ability to create income in proportion to revenue, balance sheet assets, operating costs, and shareholders' equity over time. The gross profit margin shows how much money a company produces after paying for the direct cost of production, including labor, materials, and other production costs. In the final calculation, we get 42.35%. This means Hikmat Bati Berhad's gross profit margin, 42.35%, is more efficient than industry average, 38%. How to improve the gross profit margins company, pricing policy may need to be reviewed, and it may need to change suppliers to minimize sales expenses, labor costs, and waste. The operating profit margin ratio shows how much profit a firm gets after paying for variable production costs like labor and raw materials. In the final calculation, we get 14.12%. We can see that Hikmat Bati Berhad's operating profit margin, 14.12%, is poor than industry average, 18%. The way how to improve the operating profit margin is reduce cost of goods. Reduce the cost of items sold by working with suppliers. It can save money if can negotiate a cheaper price, a volume discount, or another cost-cutting offer. Lowering costs raises the profit margin on products and can improving the income. The purpose of net profit margin is investors can use the net profit margin to see if a company's management is making enough money from its sales and if operational and overhead costs are under control. In the final calculation, we get 8.18%. This means Hikmat Bati Berhad's net profit margin, 8.18%, is more efficient than industry average, 8%. The way how to improve the net profit margins is increase revenues. Selling more goods and services or raising price can help companies boost their net profit margin. Return on assets, ROA, is a ratio that compares the value of a company's assets or to generate profit over a period of time. Managers and financial analysts use return on asset to measure how well a company is using its resources to create a profit. In final calculation, we get 12.41%. We can see that Hikmat Bati Berhad's returns on asset, 12.41%, is more efficiency than industry average, 12%. The way how to improve the return on assets is manage current assets. Current assets include cash, account receivable, inventory, and another short-term assets. We will be able to improve the return on assets by keeping them as low as possible if we can efficiently manage them. This is because they are assets. Lowering them will improve in increasing ROA. Return on equity, ROE, is a ratio that shows investors how well a firm manage the money it receives from its shareholders. In other words, it measures a company's profitability in relation to its stockholders' equity. In final calculation, we get 23.97%. This means Hikmat Bati Berhad's return on equity, 23.97%, is more efficient than industry average, 20%. The way how to improve the return on equity is increase profit margins. Increases in profit relative to equity boost a company's return on equity since profit are in the numerator of the return on equity ratio. It can be achieved by raising the prices of each product sold, lowering the cost of goods sold, and lowering overhead costs.
Marketability ratio are used to evaluate the current share price of a publicly held company stock. Earnings per share (EPS) is the company's net profit divided by the number of common share it has outstanding. Earning per share that I've calculated is RM0.35 ringgit. Hikmat Bati Berhad is good then. Industry average RM0.25 ringgit. Hikmat Bati Berhad can improve their earning per share by simply buying back their own share. Dividend per share is the number of declared dividend issued by a company for every ordinary share outstanding. The DPS that I've calculated is RM0.15. Hikmat Bati Berhad dividend per share is good than industry average RM0.14. The first is simply a rise in Hikmat Bati Berhad's net income, which are used to pay dividend. The dividend payout ratio is the ratio of the total amount of a dividend payout to shareholder. The dividend payout ratio that I've calculated is 43%. Hikmat Bati Berhad's dividend payout ratio is good than industry average 30%. Price earning ratio is the ratio for valuing a company that measures its current share price relative. Price earning ratio that I've got is 9.25 times. Hikmat Bati Berhad's price earning ratio is good than industry average 8.5 times. Hikmat Bati Berhad need to rise the price of a stock and earnings remains constant. Dividend yield. The dividend yield expressed as a percentage is a financial ratio that shows how much a company pay out in dividend each year.
As an officer of Ar-Rajahi, I will accept the application from Hikmat Bati. This is because inventory turnover ratio Hikmat Bati are higher than average industry, which is 7.48 times compared average industry is 6.5 times. Inventory turnover is measurement of how many times a retail store average industry investment is sold in a given period of time, usually 1 year. The bigger the goods turnover, the more money business make.
Next reason is because debt ratio Hikmat Bati is lower than average industry, which is 30% compared average industry is 40%. Because a company with a lower debt ratio also has a lower overall debt. A lower debt ratio generally means a more stable company with the opportunity for longevity.
Move to the reasons. As an officer Al-Raji Bank, I will accept the application from Hikmat Bati because gross profit margin of Hikmat Bati is higher than industry average. Companies need to know how much money they can keep after deducting all costs from sales when measuring profitability. The more money left over after all expenditures are covered, the more profitability the sales are. Profit margin has the advantage of allowing a direct comparison of profit and cost for any given sales level. Any cost reduction contributes to a higher profit margin.
For the limitation, it's not always easy to tell if a ratio is a good or a poor. A high liquidity ratio, for example, may imply that a company is a financially stable and as a result, efficient and is working capital management. On the other side, overcurrent ratio may indicate that the firm is not successfully managing its working capital. A high liquidity ratio might imply overstocking, difficulty collection account receivable on time, and a cash surplus.
Next limitation is ratios can also be affected by seasonal factors. Value at the end of the year may not be representative. Seasonal factors may cause some account balance to grow or decrease at the closing of the accounting period. For example, during festive seasons such as Hari Raya, Chinese New Year or a mega sale, sales are always higher.
Limitation of financial ratio. Average performance as shown in the industry average may not be desirable. Remember, published industry average are only guidelines. Logically, a company would like to be better than average. It could be better for a firm to make comparison with market leaders. Different operation and accounting practices make comparison difficult. This is because different accounting methods applied will result in different values. For example, a firm using straight line method to depreciate its asset will show a different amount of profits as compared with a company using the reducing balance method, even though they have the same operating profit before depreciation.
For limitations, it's hard to say whether a company's overall performance is good or not. This is because most ratios are not very useful on their own. Some ratios, for example, may be beneficial while others are dangerous. As a result, some of them should be integrated to form a picture of the company's current situation.